Imagine turning $10,000 into a small fortune. It might sound too good to be true, but here's the shocking part. Most successful investors started with much less. In fact, Warren Buffett, one of the richest people on earth, made his first investment at age 11 with just $120. And here's a wild fact. If you had invested just $10,000 in Amazon in 1997, it would be worth over $10 million today. So, what happens when you hit the $10,000 mark in your own investing journey? Everything changes. You stop thinking like a beginner and start using smarter, more powerful strategies. You unlock new opportunities, strategies, and ways to grow your wealth faster than you ever thought possible. In this video, we're going to show you how that $10,000 can change everything. From shifting your mindset to leveraging your money, we'll reveal the hidden strategies that the pros use to grow their wealth. Whether you're a beginner or already have some investing experience, you'll learn how to make your money work harder for you. Ready to see how your $10,000 can change your future? Let's dive in. Chapter 1. The $10,000 Mentality Shift. From beginner to investor, reaching the $10,000 mark in your investment journey is a turning point. It's the moment when you stop thinking of yourself as just a saver or casual trader and start viewing yourself as a real investor. The shift is psychological, and it's a game changer. Once you hit that threshold, you begin seeing money differently. It's not just about what's in your bank account, it's about putting that money to work. According to Warren Buffett, the stock market is a device for transferring money from the impatient to the patient. When you have $10,000 to invest, you start thinking longer term. You are no longer chasing quick gains or market hype. Instead, you begin to understand the importance of patience in building wealth. This is the moment when you begin exploring value investing principles, finding stocks or assets that are undervalued and hold long-term potential. For example, take a look at Amazon in the early 2000s. Back then, it was an undervalued company, but investors who had the patience to hold on saw massive gains over time. Once you reach $10,000, you should focus on finding businesses with strong fundamentals that you can invest in for the long run. The idea is simple. With $10,000, you can start making decisions that involve true research and strategy, rather than emotional, impulsive moves. It's about shifting your focus to assets that generate long-term value, not just temporary wins. A key lesson comes from Charlie Munger, Buffett's right-hand man. He once said, "The big money is not in the buying or the selling, but in the waiting." And with $10,000, waiting becomes easier. Now, you have enough capital to make investments that can grow steadily over time. Here's a thought. A $10,000 investment in a stock like Coca-Cola, bought 20 years ago, would be worth nearly $100,000 today, thanks to the power of reinvested dividends and steady growth. That's what happens when you stop chasing quick wins and focus on patience. This is the stage when you also start learning the importance of risk management. A small amount of capital forces you to make smarter choices, but with $10,000, you can spread your investments out a little more. Diversification helps you reduce risk while giving your portfolio a chance to grow in different market conditions. Chapter 2. Leverage your $10,000. A strategy to scale without risk. Once you have $10,000 to invest, you're in a new league. The goal now is to scale your wealth, and one of the best ways to do this is by using leverage strategically. But don't worry, leverage doesn't mean taking on high risks. In fact, if done correctly, it can help you grow your portfolio without risking your capital. Let's start with margin accounts. These allow you to borrow money from your broker to increase your investment power. However, margin comes with a risk, so it's crucial to approach it cautiously. If you invest wisely, leverage can amplify your returns. If your $10,000 investment grows by 10%, and you leverage it by borrowing another $10,000, your return doubles. But remember, margin can also work against you. If your investments lose value, you'll owe more money, which could leave you in a precarious situation. It's important to only use margin with a well-researched strategy, ideally on stocks with low volatility. Another less risky form of leverage comes from dividend reinvestment plans, DRIPs. With DRIPs, your dividends automatically reinvest into more shares of stock, compounding over time. Let's say you invest in a stable company that pays consistent dividends. If you let those dividends grow over the years, your $10,000 investment could expand without you having to inject more capital. For example, Johnson & Johnson's stock has returned around 10% annually over the past 20 years. But when you reinvest those dividends, your returns skyrocket. By using DRIPs, you can scale your $10,000 portfolio with virtually no additional risk. Real estate crowdfunding platforms offer another form of leverage, especially for those who are reluctant to invest in property directly. For as little as $500, you can invest in real estate projects and earn passive income. Many of these platforms allow you to choose projects with different risk levels, giving you control over how much risk you want to take on. The bottom line here is that once you have $10,000, it's about making smart moves to scale your wealth. Don't jump into high-risk options without proper research, but look for low-risk ways to use leverage that fit your investment goals. Chapter 3. Beyond Stocks. Alternative investments that change everything after $10,000. When you hit $10,000, your investment world opens up. It's no longer just about stocks. You can explore a variety of alternative investments that offer a broader spectrum of opportunities. Real estate, peer-to-peer lending, and even cryptocurrencies can be viable ways to diversify your portfolio. Let's start with real estate. Traditional real estate investing typically requires a significant amount of money, but with $10,000, you can participate in real estate crowdfunding. Platforms like Fundrise or Realty Mogul let you invest in property projects without the need to buy an entire property. You can start small, even with just a few $1,000s, and gain exposure to the real estate market. Here's a quick fact. According to Forbes, real estate has outperformed the stock market over the past 20 years, with an average annual return of 8–12%. This makes it a great option for diversifying beyond traditional equities. Next, consider peer-to-peer lending. This relatively new form of lending allows you to lend money directly to individuals or businesses in exchange for interest payments. With platforms like LendingClub or Prosper, you can invest as little as $25 into loans. When you reach $10,000, you can spread your investments across multiple loans, reducing risk while earning attractive returns. Peer-to-peer lending has become particularly attractive in a low-interest rate environment. Some investors have earned annual returns of 5–10% by lending through these platforms. However, it's crucial to research the risks involved, as defaults do happen. Cryptocurrencies, like Bitcoin and Ethereum, also become an attractive option when you reach the $10,000 mark. While crypto can be volatile, it can offer high rewards for those who invest wisely. A $10,000 investment in Bitcoin at the start of 2020 would have grown more than 300% by the end of 2021. However, it's essential to proceed with caution, as the market is still highly speculative. Investing in precious metals, like gold or silver, is another alternative. These assets often act as a hedge against inflation. Historically, gold has been a safe haven during economic uncertainty. With $10,000, you can buy physical gold, or you can invest in gold mining companies or ETFs that track the price of gold. Lastly, you could consider buying fine art or collectibles, which have become more popular as alternative investments. Art has appreciated significantly over the past few decades. A painting that cost $10,000 in 1990 could be worth $100,000 today. While it's a niche investment, the potential for growth is real for those who are knowledgeable. Don't forget to subscribe for more tips on how to grow your money with smarter strategies and unique investment ideas. Chapter 4. The Power of Compound Growth. Small investments with big returns. Once you've reached $10,000, one of the most powerful forces in investing is at your fingertips: compound growth. Albert Einstein famously called compound interest the eighth wonder of the world. When you realize how compound growth works, you'll see why. It's the ability of your money to earn returns not just on your initial investment, but on the returns you've already made. For example, if you invest $10,000 and earn 7% per year, in 10 years, you'll have around $19,500, just from compound interest. In 20 years, that same $10,000 could grow to over $38,000. That's the beauty of letting time and patience work in your favor. Let's break it down. Imagine you're investing in dividend-paying stocks like Coca-Cola. The dividends are reinvested automatically, which means you buy more shares each time the company pays out. Over time, the value of those shares rises, and because you own more of them, your returns keep growing faster. In fact, reinvested dividends account for around 40% of the total return in the stock market over long periods, according to research by the investment firm J.P. Morgan. The key here is to start early. If you begin investing your $10,000 in your 20s or 30s, you have decades to let compound growth work. In fact, a study from Fidelity Investments shows that someone who invests consistently over 20 years will see more than 80% of their total gains come from compound interest rather than from new contributions. To maximize this power, focus on long-term investments that have a proven track record. Look for companies with stable earnings, strong market positions, and a history of paying and increasing dividends. By staying invested and allowing your returns to compound year after year, you'll see your $10,000 grow far more than if you were to cash out frequently. Warren Buffett, the Oracle of Omaha, made his fortune not by making quick, risky bets but by investing in solid companies and letting compounding do the work. As Buffett says, our favorite holding period is forever. That's the essence of value investing, patience, and the power of compound growth. Chapter 5. $10,000 Portfolio. Picking the right stocks to beat the market. When you hit the $10,000 milestone, it's time to get strategic about building your investment portfolio. The goal is not just to pick any stock, but to identify undervalued stocks with long-term potential that will outperform the market. So how do you pick those stocks? Start by following the strategy of value investing. Look for companies that are undervalued relative to their intrinsic value. This requires doing deep research into a company's financials, management, industry position, and growth potential. One key metric to use is the price-to-earnings (P/E) ratio. A lower P/E can indicate that a stock is undervalued, especially if the company has strong fundamentals and good growth potential. Take, for instance, Apple in the early 2000s. Before it became the tech giant it is today, Apple's stock was undervalued, with a P/E ratio that didn't reflect its future growth. Investors who understood Apple's potential in the early days and took advantage of its undervaluation saw significant returns over time. Another important strategy is to invest in companies with strong, predictable earnings. Companies with a solid business model, a wide economic moat, and a track record of growth are often great candidates. Consider companies like Procter & Gamble or McDonald's, which have dominant market positions and stable revenue streams. These companies are less likely to experience the wild swings of less established businesses, making them safer investments for your $10,000. The key is to diversify your stock picks to spread risk. Instead of putting all your money into one or two stocks, allocate it across a range of businesses in different sectors. This helps protect your portfolio from sector-specific risks and provides more stability in your overall returns. There's also the option of buying into index funds, which can be a great way to capture broad market returns. For example, the S&P 500, which includes 500 of the largest U.S. companies, has historically returned around 10% per year on average. This is a simple way to diversify your $10,000 investment and still achieve strong returns over time. But for those looking to beat the market, the strategy is to focus on undervalued stocks with growth potential and hold them for the long term. A $10,000 investment in a well-researched portfolio of undervalued stocks has the potential to outperform the broader market. Chapter 6. The $10,000 Exit Strategy. How to know when to sell. Investing isn't just about buying the right assets. It's equally important to know when to sell. Once you have $10,000 invested, it's vital to develop an exit strategy that aligns with your financial goals. Timing the market is difficult, but knowing when to sell based on certain signals is crucial. The first rule of selling is simple: never sell based on fear. Panic selling is a common mistake that many investors make, often resulting in missed opportunities. Instead, stick to your original thesis for investing. If the fundamentals of the company or asset you're invested in haven't changed, then hold steady. One great strategy for knowing when to sell is using a sell target or stop-loss strategy. A sell target is a predetermined price at which you plan to sell, typically based on your financial goals. A stop-loss is an automatic order that sells the asset if its price drops below a certain level, protecting you from large losses. These strategies help take emotion out of the equation and can protect your $10,000 investment. Another reason to sell is when the asset has reached its intrinsic value. For example, if you bought undervalued stocks at $10,000 and they have now increased to a price that reflects their true value, it might be time to sell. This can be a difficult decision, especially if you believe the company has long-term potential. However, selling at a price that matches the stock's true worth allows you to lock in profits and reinvest in other opportunities. Some investors also sell when the company's growth prospects change. If a business starts facing significant challenges, such as losing market share or facing regulatory issues, it might be time to cut your losses. On the flip side, if the company announces a new product or expansion that could lead to higher growth, it might be wise to hold or even buy more shares. When it comes to taxes, consider selling assets in a tax-efficient way. For example, long-term capital gains are taxed at a lower rate than short-term capital gains, so it's better to hold investments for at least a year before selling if possible. Finally, always have a reason for your decision to sell. Whether it's because your investment has hit its target, because the company's prospects have changed, or because you want to take profits, make sure it aligns with your investment strategy. The $10,000 you've invested is hard-earned, and knowing when to sell is just as important as knowing what to buy. By setting clear goals, sticking to your plan, and avoiding emotional decisions, you'll ensure that your exit strategy is just as smart as your entry. Thanks for watching. If you found these strategies useful, don't forget to subscribe for more tips and tricks on growing your wealth the smart way.